Welcome to the Ask the Financial Counselor series in partnership with the Greenville County Library System and the Greenville Financial Empowerment Center. My name is Lori Ford, and today we are going to talk about understanding student loan repayment. First, I want to talk a little bit about the Greenville County Human Relations Commission, our agency. We provide several types of service, with the Financial Empowerment Center being one of them. We offer free one-on-one counseling to clients focusing on improving their savings, improving credit, reducing debt, affordable banking, and other services. We also help clients with reverse mortgage counseling, foreclosure prevention. We talk with clients who are maybe experiencing eviction or landlord and tenant disputes, any fair housing or discrimination issues. Once a month, we have a home buyers education class, and we also help clients with rapid rehousing if they're experiencing homelessness. We have received COVID funding to be able to assist any clients who are struggling with their mortgage, their rent, or utilities if they have been impacted by COVID. So when we talk about the types of student loans, we have two types. We have public and we have private student loans. Public student loans have a fixed interest rate that's set by the government each year. And there are three main types. There's the FFEL, which are student loans that were made by banks. That program is no longer in existence. We have the William D. Ford, also known as direct loans or direct Stafford loans. And then we also have the Perkins loans that were made by schools, and that program ended in 2017. Private student loans, the interest rate can vary between lenders, and it's often based on your credit score and your credit worthiness. And so these private loans can be made by banks and financial institutions, can be made by schools, maybe by finance companies. Today, we're going to be talking about the public student loans in this video. And so if you're facing any kind of hardship with your private student loans, you're going to want to reach out to those lenders, those loan holders, and ask them if they have any programs available for you. You may also be able to refinance those private student loans, but again, it's going to be based on your credit score and credit worthiness. So just some words to know that we often have questions about. Sometimes clients want to know what's the difference between subsidized and unsubsidized loans. So subsidized loans are those loans where the government pays the interest for you when you're in school, during any grace periods, and also if you are in deferment. Unsubsidized, which happen to be very common, is when the borrower is responsible for the interest at all times. And then we also have clients asking about deferment and forbearance. And those are just periods that allow you to temporarily stop making payments or maybe reduce the amount that you pay. And so your loan servicer will decide between whether or not it's a deferment or a forbearance. It just really typically depends on the hardship that you're experiencing. So when we talk about our government loans, the government is the loan holder, okay, but the payments are made to loan servicers. So the loan servicers are the ones that are responsible for collecting those payments, those administrative tasks. So they'll respond to your questions, they'll report your late or on-time payments to credit bureaus, and they also let you know when your payments are due. And so you can see the federal student loan servicers. And so you may recognize one of your loan servicers in that list. Payments are required to start 6 months after leaving school or 6 months after dropping below half-time enrollment. And it does not matter if you've left because you've graduated or if you've withdrawn. And when you're sending in your payment, a payment is split between the principal, which is the amount that you borrowed, and also the interest, which is considered the cost of borrowing money. And the payment is applied to the interest first and then to the principal balance. So, in paying your public student loans, you have two options. You have what's known as the traditional payment plans, and then you also have the income driven repayment plans. Traditional payment plans are those plans where the monthly payment is based on the amount that you borrow. So if I borrow 10,000 and you borrow 10,000 and we got our loans around the same time with the same interest rate, then every month we are going to have the same monthly loan payment. And the loan payments are split up evenly so that they can be paid off in the years that you see beside the plan. So the standard payment plan, you'll have your loan payment split up so that it's paid in full in 10 years. The graduated payment plan is still 10 years, but it starts low and then the payment gradually increases until it's paid off in 10 years. And then we have the extended and the extended graduated, which will be paid in full in 25 years. Now, our income-driven repayment plans, those are based on your household income and your family size. So even if we borrow the same amount of money, but yet I have a different family size, or maybe I make less than you do, then my payment is going to be different than yours. There's a specific formula used to calculate how much your monthly payment is going to be. And then also, you may be put into one of these four plans. And so we've got the repay, the pay, the income contingent, and also the income-based plan. And so you can see that it depends on when you took the loans out will determine whether or not you're paying 20 or 25 years and which type of plan you're actually eligible for. At the end of those 20 or 25 years, any loan balances remaining will be forgiven. So you won't have to pay any more money after the end of those payment terms. However, the money that is forgiven will be considered income. And so you may be required to pay taxes on that income when it is forgiven. On studentaid.gov, they have a really neat simulator for loan repayment, and you can go there and you can practice to see how much your payment would be under one of those four plans. We encourage our clients to sign up for an account with studentaid.gov because it will pull in your specific loan information so that you can use it in the loan simulator. When you're repaying your loans, everyone is started on the standard plan at first. So everyone started on that plan that splits the monthly payments to be paid off into 10 years. If you want to enroll in a different traditional plan, you'll end up contacting your loan servicer. For the income-driven repayment plans, you'll apply at studentaid.gov. So again, it's very handy to have an account on studentaid.gov. You can apply by mail or you can apply online, which is the best option. With income-driven repayment plans, you do need to recertify each year or you'll be taken off the plan. So your loan servicer will reach out to you and let you know when it's time for you to recertify, and you want to make sure that you go ahead and do it by that date so you stay on the same plan. It's just a little bit more of a hassle if you end up being taken off the plan to get back on again. A few of the other things that clients talk about when they come see us is delinquent and defaulted student loans. So you are considered delinquent on your student loan if you are anywhere from 1 to 270 days late on making that monthly payment. If you're over 270 days without a payment, then you're considered in default. And once you're in default, you can be sent to collections, which will negatively impact your credit. They can also garnish your wages and your tax refunds, and it can make it more difficult for you to receive future student aid. So if you're facing any default or delinquency, we would love to help you get out of default and set your delinquency straight. We also talk with clients about public service loan forgiveness, and this is a government program that forgives the remaining balance of your federal direct loans if you meet specific qualifications. So you have to work for a qualifying employer, which is typically a nonprofit or a government entity. You have to have the right type of loan, which is a direct loan, and be on an income-driven repayment plan. And then once you've made 120 payments, your loan can be forgiven. And these payments do not have to be consecutive, so they don't have to be back to back. To sign up for the program, you'd first complete an employment certification form at studentaid.gov, and you have the option of mailing that or faxing that, but that is the first step. The great thing about this is that there is no tax owed on the amount forgiven. It's absolutely forgiven outright. So student loans involve a lot. And if you have any questions or need help with navigating your student loans, we would love to help. We'd love for you to give us a call. You can call us at 864-467-7503. We can help you book an appointment so we can go over your loans. Or you can go to greenvillefec.com and schedule an appointment with our financial counselor. We would love to see you. Looking forward to working with you.